Hey, good morning, options traders, and happy Monday. I hope everybody had a fabulous weekend. And last week, I received an email from one of our traders who said, "How do you calculate the maximum gain for a calendar spread?" He said, "I know how to do it for the vertical spreads and butterflies and others, but I can't seem to figure out how to do it for a calendar spread." Well, there's a very good reason, and let's go find out what it is. But as always, before we do, please be sure to click like and subscribe. It's definitely very much appreciated and helps so much to promote the channel. So quick recap, what is a calendar spread? Remember, it's a strategy where you are going to buy a call, you will sell a call, and they have to have the same strikes. That's really the big key to a calendar spread. But they also have to have different expirations. So remember that all spreads are going to be long and short assets. The calendar spread means they have the same strikes but different expirations. So for instance, let's say that you buy the 120-day $100 call, and maybe you sell a 30-day $100 call. So this would be a calendar spread. It would be a long calendar spread because you are in possession of, or that you own, the longer dated option. If you flipped them around, if you sold that one and bought the short dated one, it would be a short calendar. But either way, you're going to find out that you're going to run into problems trying to find out the max gains and losses. So let's use this one for an example, and let's say that you pay a net debit of $3.50. That, of course, is going to be your maximum loss. In the options market, whenever you buy an option or buy a spread or anything, the amount you pay is the amount that you can lose, your maximum. But what about the maximum gain? What is that? Well, let's take a look at what this calendar spread looks like from a risk graph. And this is what it looks like, a little bit of this upside down V shape. And as long as the stock is somewhere between these break-even points, that's where this black curve crosses zero, you are going to make some type of a gain. But your maximum gain is right here at the peak, if the stock closes right at those strikes. Now, the thing is that whenever you see a risk graph like this for a calendar spread, it assumes that the short options are at expiration. So in this example, you are long the 120-day call and short the 30-day call. Well, this is assuming that 30 days have gone by and that you're now long a 90-day call, and the one that you shorted is at expiration. There's no time left. And that's giving us this black curve. Unfortunately, a lot of times traders believe that this is the way that the curve looks all of the time. It doesn't. When you first put this strategy on, it looked more like this. You had no areas of profits, everything's underwater, and as time goes by, this red curve right here starts working up towards the black. These wings out here start to sink as they start to lose time value. Now, another way that you can tell this is, do you see how this black curve has curved lines? A lot of times when we're looking at risk graphs, such as a long call or a vertical spread, they're either flat or they're angled. It's either your delta 1, delta -1, or your delta 0. That's all you're going to get at expiration. But when you're dealing with a calendar spread, that is not true. And that's because you have one option that's at expiration, that's the short position, and you've got one option that still has time to go. So you're not going to get any kind of straight lines. So that's another clue that you're not looking at expiration of both options. You're looking at the expiration of the shortest dated one. So now, having covered that, let's talk about the maximum gain. Here's the thing about the maximum gain. It is theoretical. That's why you can't figure it out. That's why there's no formula for it, or at least an easy formula. So in our example, you were long the 120-day call and short the 30-day call. Now 30 days later, this option, the short one's going to be at expiration. So you're going to be long the 90-day call and short the 0-day call. Let's say maybe in the last few seconds of expiration. And so that's what we mean by when you are at expiration. It's still technically alive, but you've got maybe the final seconds to go on expiration day. Well, the question now is how much time value remains on this long option right here? Well, good luck. We don't know, because we do know that this is our risk graph. And the reason for this peak right here is because the long option hasn't expired. Yes, we bought it with 120 days to go. Now there's 90. But what is that value with 90 days to go? We have no idea. So that's why this is a theoretical amount. You can't just put this into a simple formula like you can with other spreads and say, here's my maximum gain. Now, again, the maximum gain occurs if the stock is right there at 100. All right, so that maximum gain is unknown. However, because the maximum gain is unknown, these break-evens out here are also unknown. This left one, we have no idea. What about the right one over here? We have no idea. Why? Because in order to figure those out, we would have to know what this value is and then figure out how far the stock could move before we just broke even. And because we don't know the maximum gain, we also don't know the break-even points. Now, you might say, well, how am I supposed to make decisions? Well, you can always go into a pricing model, but for those of you who have ThinkorSwim, they've got a nice little hidden theoretical calculator right there on the Trade tab that can help you to make these decisions. So let's go have a look at ThinkorSwim. So now we're into the ThinkorSwim platform, and the way that you get to the theoretical pricing model is, first of all, let's change our strategy up here to a calendar spread. And let's just say that we picked this pair right here. Now we can choose other pairings, but just for the example, I'm going to use this one right here. Now the underlying is Tesla, closed at about 228. So let's just use the 230, which would be roughly the at the money. And what it's telling me is that on today's date, which is October 30th of 2022, this calendar spread is worth about $6.12. Well, what's it going to be worth in a week from now, or 2 weeks, or at expiration of the short? How would we figure that out? Well, again, you'd have to turn to a pricing model, but there's a very simple way in ThinkorSwim. And what you can do is up here in any of these columns that have that little white triangle, it allows you to change it. So notice right here, I have gone to Option Theoreticals in Greeks, drop right down here to Theo Price, that is theoretical price. And that's what that column is right there. Now up here, there's a little calculator. Let's choose that little white arrow to expand it. I can make changes to the stock's price. Notice that this is a stock price adjustment. So if I want to say that the stock is up 2 points, I would just make that 2. I would not make it 230. I can change volatility as well. If I think that volatility is going to increase 5 points, I would make that 5. If I think it's going to drop 3 points, I would make that -3. And it's going to take all of these factors into account. But watch this. If I click on this little plus sign, if I start advancing the clock, watch this price right here at 613. That's our 230 calendar. So watch what happens as we start. There it goes to 618 and then 623, 628. You can see that it just keeps clicking along with each passing day. So I can come back up here to this calendar and I can say, well, what's it going to be worth at expiration of the short, which is going to be in December. So let's click over here to December. There's expiration Friday, and we can see that it's telling us that this is going to be worth about 15 bucks. Now, of course, that's assuming that the stock is right at 230 and we are right there at expiration and we haven't had any other adjustments to volatility or, again, the stock's price. But it's a really nice tool that gives you a simple way to figure out what a calendar spread is worth without having to write a bunch of information down and go over to a pricing model. So for those of you who have ThinkorSwim, this is a really good, simple way to figure out your max gains for your calendar spreads. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.